News. Meantime, let's get to a street fight. Executives from the NYSE and Deutsche Börse took pains today to convince investors this deal is not a German takeover of an iconic U.S. company. But is it, and is it bad for America? Our next guest says yes to both questions. We are joined now on the fast line by Sal Arnott, co-founder of Themis Trading. Sal, great to have you with us. Is it irrelevant, though, whether or not this deal is good or bad for America per se? In terms of the trading perspective and individual investors and investors out there, nothing really changes, does it?
No. Well, first of all, thanks for having me on. I'm a big fan. I'll tell you this, though. While everyone is wildly positive for the deal, and there's no doubt that it's good for the executives, and it's good for the New York Stock Exchange, it is an outright failure in this way. It's an admission that the exchange's recent for-profit model has diminished and crushed margins in the cash equity space, and that is the reason why they need to team up with a foreign player, with the Deutsche Börse. And that it's all about derivatives. The exchanges have become server farms. They make their money not from new listings, not from bringing new capital to the public markets, but by selling data feeds, selling market data, and selling co-location space.
Hey, Sal, I'll assume that that's true for a second, but that failure happened 2 regimes ago. That was during the Grasso era, right? I mean, Duncan had nothing to do with it, and to a certain extent, neither did John Thain. So if there was a failure, at least they're admitting there was a failure and doing something to rectify that, no?
Well, you know what? It's not a personal thing, and it actually, it probably goes back to 2005, because that's when New York Stock Exchange became for profit, and 2006 they became public, and then 2007 they got help from the SEC with Reg NMS. So it's all of these things all combined, and it's not just a New York Stock Exchange problem. But the SEC and the exchanges have created this Frankenstein market structure. In the U.S., 13 exchanges, 40 dark pools that cater to high-frequency traders in the extreme. And it's eviscerated margins in the cash equity business. It's turned it into a wasteland.
But Sal, great points. But how else do you compete with technology and the rest of the world that needs and wants to be in this space and will steal market share otherwise?
Well, there's no doubt that New York and Deutsche Börse had to combine and do this. By doing it, they become second to, Hong Kong? Hong Kong's $25 billion now. This combined entity will be $23 billion. All right, and then you have Bethesda, and then you have CME, which is huge. Right, so they do need to do this, but at some point, the grown-ups need to question the whole for-profit exchange model, because the exchanges used to be a utility and safeguard investor interests. And now with this model, they move through equities. Now they've taken away the margin. They're going to move through derivatives overseas. And here's why I'm concerned. I'm concerned for 2 reasons. First of all, May 6th is what happened when high-frequency front-runners went crazy front-running a Midwestern mutual fund on an E-mini order. What's going to happen when we have this same market structure playing in the derivative space? So you'll have highly leveraged high-frequency guys trading highly esoteric derivative products that they don't know or understand either. That's got to be scary.
Sal, just a quick question, John Najarian. I love your work, and I follow your tweets.
You're kind.
One of the questions I have, though, is that in Europe, they don't do a lot of what the problems are that you've identified and Guy and Tim have spoken to as well. They don't do those kinds of trades. They don't have the dark pools, and they don't have a lot of the issues that we have here. So by Deutsche combining here, I don't see that stretching it. I see it perhaps stopping it here at our borders. I don't see it infecting over into their markets, because their regulators are a little more on the ball than ours.
Well, and that brings up another good point. I hope you're right, but think about this from a regulatory perspective. Look how slow the SEC and the CFTC have been to address flash crash, to address flash orders, which they wanted to ban 2 years ago.
Yep.
All these things, look how slow they've been in addressing it. Can you imagine once we start getting the FSA in England and the EU regulators and try to get them together with our own bureaucracy, and how are they going to keep this global fragmented web from imploding somewhere? I mean, that's got to be a concern.
All right, Sal, we have to leave it there. Thanks so much for your analysis. Certainly an interesting take on the situation after a full day of hearing so many analysts very bullish on the back of this deal. We do want to get back to Dell, which is another big story.